Welcome to India's #1 budget headquarters. Decoding key policies, delivering market-shaping insights, and unlocking the potential of India's growth blueprint. Beaming live from the CNBC-TV18 Motilal Oswal Budget Headquarters.
The Taiwanese index, though, continues to outperform as it has all through the week, 0.5% higher there.
Kotak Securities estimates a quarterly slippage ratio of about 1.5%.
Bank Nifty, the resistance levels are twofold, 58.93. We never got to it yesterday. 23,740 on the Nifty. The Nifty Bank is up about 75, 50,400 plus.
Overall guidance for H2 was to double our square footage in the quick commerce business.
Markets a bit of a muted day coming in. Not much of an excitement that we're seeing coming in.
Governor Sanjay Malhotra's debut policy meeting, one of the most closely watched in recent history.
Middle East and India. And we think both these are markets that we can do better in.
496 crore rupee profit, marginally below the expectations of 519 crores. The revenue figure absolutely in line with expectations. Counting down to numbers of State Bank of India, which will be reported any time now.
Hello and welcome. That was the day so far. You're watching Closing Bell live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me are Surbi and Nigel for the markets. The Nifty is below 23,600, nursing a cut of more than about 100 points. Mid-caps are underperforming after yesterday's outperformance, and it's pretty much a reversal. Many of the stocks which did well yesterday, like defense, capital goods, PSUs, these are stocks which are under pressure. But what's disappointing is some of the earnings, right? Trent is one. The other one is BEML, where we've seen a 50% drop in their profits on a year-on-year basis. Thankfully, SBI is largely in line, but we'll wait for the press conference now.
You know, what's disappointing is actually the market as a whole. Because we've had a pretty decent global setup. Most global markets have been okay. Europe is fine. Wall Street futures are fine. Most of the Asian markets were up. And you would have wanted, the bulls would have wanted to see a little more of a follow-through. Yesterday, we said it's okay. You know, index is not the place to be. Mid-caps is the place to be. But today, no mid-caps, no index. And we've been struggling throughout the session.
Well, you know, a couple of points, actually. I think today's session is par for the course. You know, and the reason I say that is because we're getting to a big event tomorrow. We have the new RBI governor that will be addressing, the press as well. So I think some kind of profit taking ahead of that event is par for the course, according to me. And we have had a good run as well. So some money being taken off the table. I think still, you know, till that 20,200, 20,250 mark is held out, I think the trend will still be up. You know, and today we also have an expiry-related factor that's playing out. So a big event tomorrow, you have an expiry-related factor that's playing out, weekly expiry as well. And then over the weekend, you have the Delhi state elections. So put all this together, I think a mild pullback on the Nifty is par for the course. The flag bearer of the market is the Nifty Bank, because that is still flattish. You know, we're not seeing that, see any kind of pullback. And just a word on SBI, we had made this point earlier today that it went into its numbers weak. So the numbers has to be very, very weak for it to see some follow through on the downside. To be fair, the first look at the numbers, the stock did move lower. And from there, did see a bit of a bounce. Why is that? Because the street was net short on it. The numbers pretty much in line. And I think the slippages number as well has come in a little bit low on a sequential basis. So put that together, the stock is not falling off the cliff because the street was positioned for a weakish set of numbers or a softish set of numbers. So, you know, there's just a couple of points.
No, I completely take that, and no arguing against that point. Very, very logical, Nigel. The fact that the street perhaps is just digesting some of the gains. I mean, 23,700 almost. That's where we started this morning. So it's been a nice ride up. So maybe just kind of, you know, cooling it a little bit before tomorrow's much talked about, interest rate cut expectation. But on trend, that's the other stock. And that's what I've been thinking about, because anyway, the stock has been pummeled. Anyway, you know, 8,000 rupees stock became a 6,000 rupees stock. And now look at that, 5,388 on trend. And the numbers weren't really that bad. I mean, margins were in line. The growth is at 30%, but I think it's that question the market has.
But the growth rate, right? In Q1, the revenue growth was 57%. In Q2, it came to 40%. And in Q3, now you're down to 35%. So 35 in absolute terms is fine, but when you're trading at 80 times forward multiple after the correction and your growth rate is moderating, then it's...
You know, this is not a malaise that plagues only a stock like Trend. This is a classic issue with any growth stock. You will say the same for something like an Nvidia in the US, that can those growth rates of, 100%, 80, 90%, can they continue? Remember, Nvidia had sold off after its numbers as well because they grew at 80%. It wasn't enough given the valuations and given the run-up. And that's exactly the kind of problem that seems to be playing out on some of these high-growth names here as well. Trent right now, big pressure, 6.5%.
I think margin for error is very, very limited on some of these stocks that have run up. Case in point being a solar industries. Now, the stock from the highs of the day is down close to around 8.5% or thereabouts. They had a con call earlier today at around 11 a.m. and I think they were talking about pulling back some kind of revenue growth. They're talking about 8 to 10%. Earlier, they were talking about mid-teens. Just take a look at the stock. It had that big order win that got confirmed. What is the name of that? There was that Pinaka.
The
take a look at the stock here. It's down close to around 6%. It was up 2% early in the morning. So the margin for error on some of these names are very, very limited, particularly with the kind of run that they've seen in the last 12, 18 months or so.
Okay, as we move on, very quickly, let's pull up the intraday chart on SBI. The good in the numbers is that asset quality is stable. There is no rise in slippages. Gross NPAs are looking better quarter on quarter as well. That's sort of pristine. And of course, there's been growth coming in. I think the market's going to debate around this whole margin business, whether they can, hold above 3% or not, because there has been a slowdown in margins as expected. They're absolutely at that line, the 3% line now. Let's see how this goes, because we're also perhaps getting into that, rate cut cycle starting tomorrow. We'll get more on SBI in just a bit. We'll hear from the SBI management. Lots of other nifty earnings also lined up. Let's get started. We have Mitesh joining in. Mitesh, hi. Good to have you back on. I remember in the morning we were talking about the prospects of starting a long trade. Intraday basis, I don't think longs have really quite worked out as planned. But what would you say? What would the trading bias be for you, Nifty and Bank Nifty? 1 hour to go before, of course, tomorrow.
So, on the Nifty, it hasn't worked out. On the Bank Nifty, I think, it's trying to recover. And both the investors, the structure for me is positive. We bought some Nifty around the 23,600, 610 mark and kept a slightly deeper stop at 23,480 on the spot. So, we've taken the trade. The indicator and the averages on the hourly global chart still remain on the upside. And therefore, I think as long as 23,480 is taken out, I would maintain a positive stance and go with the long trade. On the stock side as well, the idea is that because you have a positive bias in the index, you are looking at some buying opportunities on the stock side as well. And I have Axis Bank as one of the recommendations. Axis Bank is a buy with a stop below levels of 1,000. Look for targets of 1,050 to begin with. I suspect if the broader reversal plays out, then we might even look at slightly higher levels on the chart of Axis Bank. And the other one is Chola Finance, which was a buy a few days back as well. It did very well, and last 2 days given a pullback. So keep a stop below 13.55 for a target of around 15.20.
Okay, that's the call coming in on individual stocks. Let's get to PVR Inox. Reported the Q3 numbers. The revenues were slightly below street expectation. Revenue growth came in at about 11%. Margins, though, missed the street expectation. There was a sharp rise in movie production and distribution costs. We have with us Ajay Bijli, Managing Director, and Gaurav Sharma, the CFO of the company, joining in. Thank you very much for joining in. Mr. Bijli, 11% growth so far in Q3. What about Q4? Because we've got some big ticket releases coming through. What can you guide the market in terms of Q4 and even the pipeline, at least for the first half of FY26?
Well, we've got a big Salman Khan movie coming. We've got some English movies coming. Hollywood had suffered in the first 6 months because we did not have, the strike, impact of the strike, screenwriter strike was still there. But from third quarter onwards, Hollywood is back. So we're, excited about that. Captain America is coming. Some two very big, there's a big Chhawa, which is a big, Vicky Kaushal movie, which is coming. And there is this Superman, Mission Impossible. That's next year, first quarter. So I'll just talk about Hollywood first. And from this quarter, which is coming up just now, we've got this Ajit Kumar movie, which is a Tamil movie, which is coming. Thandel is coming, which is a Naga Chaitanya and Sai Pallavi movie. So I think the momentum that we are always looking for in our business is building up, which is most important. So whether it was Pushpa, whether it was a Skyforce, all these movies created that momentum. Even the re-releases have created a momentum. And that is what we've been looking for. And so exciting times ahead.
Do you think the pipeline, sir, for Q4 is looking better than what we had in Q3, which sets you up for a better performance in the March quarter? And even the contribution of regional this time and the re-releases, because that's doing well. What was the contribution in the current quarter?
No, I won't say Q4 has got a better pipeline than Q3, but it's just that it's Q4 is the way every year Q4 is. But yes, we have some big movies, and sometimes surprises do crop up, as I said. So it's a decent enough pipeline. It's an exciting pipeline.
Ajay, hi. Occupancy around 25%, is it, in Q3?
Yes.
So I want to sort of talk about that because the the content pipeline has been looking good. Third quarter as well. It was lots of new releases plus the re-releases like you mentioned. Do you see that number itself, that occupancy number, pushing higher, or is 25% like the steady state new normal, so to speak, post-COVID normal?
No, this year, in fact, we had the weakest movie pipeline. So in fact, I don't think occupancies will remain here, because next year Hollywood is bouncing back. Hindi movies, there was not a single Khan movie, so to speak, this year. We did not have any Shah Rukh movie, any Aamir movie, any Salman movie. Salman movie is coming literally at the fag end of the financial year, 28th of March. We did not have any Hrithik movie, any Ranveer movie, any Ranbir movie. Ranveer only came in an ensemble movie, Singham. So given that and the Hollywood pipeline not being very strong, this was not a very good year as far as content is concerned. All that is going to change in 25, 26, where all the people that I mentioned just now, their movies are coming. So I'm expecting that to result in better occupancies next year, for sure.
Okay, fair enough. So, the content pipeline is, something that you don't entirely control. Let's talk about your controllables, because they're looking better. Whether it is the average ticket cost or the F&B spends, they've all been ticking higher, right? What can you guide on this? Is there elbow room to maybe increase ticket pricing in Q4 and rolling into the new year? And also on F&B, because that's an area on which you folks have been really focused on to drive up more revenue from there. And there was some talk, I remember a couple of quarters back, we also discussed maybe a new foray, which could be, going beyond the obvious F&B at the cinema theater, at the movie theater, maybe sort of distribution at home, etc., in malls. So where are you on that plan?
Well, I think that with 159 or 150 odd million people coming to the cinemas, having a footprint of 15 million square feet, and having a good connect with the consumer on our brand equity, we want to pivot the company into three different verticals. One is, of course, cinema business, exhibition business, which we are focusing on reducing our costs, trying to get people in through various innovations that we do. On the other hand, we want to look at F&B beyond post-ticketed F&B. So the JV with Devyani to do food courts, a tie-up with Zomato for home delivery, 4700 BC, taking some of our own brands which are inside, pre-ticketed to post-ticketed to pre-ticketed. So also food is going to be a very big play. And third is a fun component, 3 Fs as I call it. And that is like what we've done with the candlelight screening we just now had, where we were showing live musical performances. We showed the Taylor Swift concert, BTS. We're talking to various people who are coming and watching events in the stadiums. If you can get digital rights, theatrical rights of that. I think the fun element, repurposing certain cinemas of ours and having some more activities, more engaging activities over there as well. So I think the three pillars on which PVR is going to pivot is going to be food, fun, and film, and not just be on content.
No, absolutely, Ajay, exactly on that point is where we were hoping to get some more numbers. But, allow us to deviate for a little bit. If you folks can stay on for a couple of minutes, that'll be great. We also have the SBI management speaking as we are talking to you. Let's quickly get an outlook going with SBI.
0.24%, and PCR continues to be robust at 75% almost. So in terms of the business growth, at the end of Q3 FY25, deposits have crossed 52 trillion with more than 51 crore customers. I think we take pride in serving the range of customers. Our bank serves 1 out of every 3 Indians, and in some way we see that SBI touches every Indian family. The total deposits have grown by 9.81% year on year to 52.29 trillion. Term deposits have grown by 13.47% in year-on-year. Our current account deposits have grown by 14.22% year-on-year, and CASA deposits have grown by 4.46%. I'm glad to share that the credit growth continues to be robust across all segments, with all the major segments registering double-digit growth. Our domestic advances have grown by 14% year-on-year, driven by 18% growth in SME, 15% in agriculture, 15% in corporate, and 12% in retail personal segments. Our foreign offices advances have grown by 10.35% year-on-year. The domestic credit deposit ratio was at a healthy 69% at the end of Q3 FY25, indicating sufficient headroom to address future growth requirements of the economy. The bank continues to demonstrate industry-leading asset quality at this scale. The slippage ratio for Q3 FY25 was 0.39%, while the credit cost for Q3 FY25 stood at 0.24%. The net NPA ratio improved by 11 basis points and stands at 0.53%. We have a well-provided NPA book with PCR of 74.66%. The asset quality of the bank has continued to remain strong over the last 5 years, which demonstrates the quality of our loan portfolio, the robustness of our underwriting processes, and the leadership of the bank across business lines. Our capital adequacy ratio is at 13.03% without considering the plowback of profits and is well above the regulatory requirement. If we include the profits for 9 months FY25, our CAR would be at 14.5%, while the CET1 ratio will be 10.99%. Based on the current profitability and growth profile of the bank, we believe we have sufficient headroom to take care of business growth requirements.
Okay, so that's Mr. Sethi just recapping the Q3 numbers. What we'll do is we'll quickly dip back into State Bank of India the moment they start talking about the future outlook and, of course, the expectations from the RBI. Right now, back to that conversation with Ajay Bijli as well as Gaurav Sharma. Talk about trends with PVR. Gaurav, if I could come to you, just put some numbers on it, exactly what Ajay was describing, on both on the ticket pricing, whether you see further headroom. I mean, can you touch, say, go up to 300 or so in Q4, and also the food piece that Ajay described in detail, including the tie-up with Devyani. How much can we expect food to contribute, say, in FY26?
Sure. I think if you look at the growth in our ticket pricing year on year, we have delivered almost 4% growth despite of lack of, Hollywood films and big mega blockbusters from Bollywood. There's been a growth in ticket pricing. I think going forward with a very strong lineup from Hollywood, which are typically, focused towards urban family audiences, etc. We feel that there is definitely headroom for growth on ticket pricing. F&B is concerned, I think F&B continues to be one of the focus area for us. Our growth in F&B revenues year on year has been almost 9%, which is faster than the growth in box office. We've been carrying out a lot of initiatives on F&B, as Ajay was explaining. We've opened the first food court in the month of December in the joint venture company with Devyani. And there is a full plan for the next 12 months to open more food courts. I think we are focused on growing F&B at a fast pace, and there is definitely headroom available for further growth on SPH and F&B.
Hi, gentlemen. Good to see you and Ajay as well as Gaurav. Give me two numbers. The ad spend seems to have recovered to the highest we've seen the last few quarters. Do you expect the momentum to continue out here? And the second part is the net debt number. That's come down, I think, by a closure around 18%. It's clocks at around 1,000 crores. Further room to reduce both these two. And gentlemen, I want some numbers. So please help me out with that.
Well, ad sales, we're very happy with it. I mean, still there are lots of advertisers and sponsors who still feel that the uninterrupted, undistracted viewing of ads that comes on the big screen is unmatched. That people are coming back to the cinemas, and which is the reason why they're happy to. So ads will remain, ad income will remain the way it is, or in fact may become even better. I don't have exact numbers I can't give you, but we're very happy with the results that we've got this quarter, and we see this continuing. As far as net debt is concerned, of course, Gaurav can reduction can answer that. But I just want to make one point over here is that we've gone into a capital light model. A lot of our cinemas, 100 screens we have signed now already, in which is a FOCO model, which is franchise owned but company operated, the way hospitality industry does it, and a lot of retail companies have done it. We already have a lot of capital that we've deployed in the business, and we believe this is the time now for us to monetize on the brand equity that we've been able to build with the developers, with the retail community, and with the consumers. And there's no reason why if hospitality companies can do it, why can't PVR INOX also work on a model where other people are spending and we manage cinemas for them. So the asset light model and the FOCO model has also reduced our capital intensity, and that's why you see a net debt reduction also happening.
Just a quick word then, on the margins.
Right, I think Gaurav wants to come in as well and add to that point. Yeah, Gaurav, go ahead, and then Rima wants to know about the margins.
No, I think Mr. Bijli has summarized it well. Nothing incremental other than the fact that we are very focused towards our capital allocation strategy as we pivot more towards asset light. We are pretty hopeful that the net debt will further come down. Bringing down leverage in our business is one of the key priorities for the management going forward as well.
There appears to be higher movie production and distribution costs, which sort of are keeping your margins capped. What is the outlook on margins? Have you seen a spike in your production distribution costs? Is that a worrying trend? And again, just one follow-up on this FOCO, the number of screens that you will add. What is the guidance for FY26 in terms of screen additions?
So as Mr. Bijli said, we have signed up about 100 screens under the asset light model, and these screens will come up over the course of next 2 to 3 years. As far as the next year financial year guidance is concerned, I think majority of our new screen openings will be in the asset light model. Without getting into specifics, it will be more than 50% new screen additions under asset light. So yeah, I think those are the numbers.
And on margins?
On margins, I think, to your point on film distribution, in fact, film distribution revenues have multiplied almost 2.5 times compared to last year. We were the distributors, PVR INOX Pictures, our subsidiary company, was a distributor for Singham again in Q3, which did exceedingly well, collecting more than 300 crores. And there was therefore an increase in revenues and a corresponding increase in costs as well. Typically, distribution business, EBITDA margins are slightly lower than exhibition business, as a result of which there is a slight impact on margins, but overall contribution to profitability has been incremental.
Okay, all right, gentlemen. Appreciate you joining in and giving us that take. Thanks, Gaurav, as well as Ajay, for joining in. And as you all said, things will improve from here on. Off to the movies. Let's see how we see that recovery play out for this quarter and the coming quarters as well. Thanks for that. That's about PVR. But let's cut across to the SBI press conference. We have the management who's addressing the press.
Excellent asset quality and home loan category. And we also have seen a significant growth in the personal gold loans and pension loans. What has not grown the way it was growing is the express credit, which is unsecured personal loan. Last quarter also we mentioned that we are making some systemic improvements in terms of our delivery of this unsecured personal loan. We wanted to make this journey completely digital. While it is also a fact that in the systemic level the unsecured personal loans are coming, and we are not an exception on that. But our portfolio is of a different category. We normally give to the salary class who maintain salary accounts with us. And to answer your question in terms of coming back, I think we are seeing that the unsecured personal loan in our portfolio is showing good growth in the current quarter, which means that whatever we have had a lower growth rate in the last 3 quarters, we're able to reverse that now. And hopefully, I think we may not have that 30 to 35% CAGR in the unsecured personal loan, but definitely we'll come to the double digit in there.
So my second question is on asset quality. Across the sector this quarter, we have seen that there has been a spike in unsecured loans. Microfinance has been a pain point for everyone, NBFCs as well as banks. What is your sense on the asset quality for your bank, in the sense, again, on the personal side? Because I think corporate loan books are still pretty, I mean, the other side of the cycle. So what's your sense on the personal side and unsecured?
You're right. I think corporate book is holding up very well. That is also because many of the corporates have deleveraged and they're in a much better position. And also we have strengthened our corporate underwriting. I think you should give some credit to us on that. But in the RAM segment, SME is doing very well. And agriculture is holding up in asset quality. Retail personal, in the microfinance, we are not very significant player on the direct lending. And even lending to MFIs also, our portfolio is limited. We have about 10,000 or 11,000 crores. We have not seen any major movement there in the MFI lending. Our own portfolio of MFI is very small. So having said that, we do see some stress on the microfinance in the industry. And I hope that the refresh, 15-day refresh in the credit information company data will help lenders to underwrite in a better manner. I think that will be addressed going forward, I believe.
Next question we have from Sangeeta Mehta of Economic Times.
I just wanted to add, sir, sequentially, actually, in all the segments, we have the NPS have gone down. Individually, agriculture, retail, personal segment, SME, corporate, you name it, we are all down quarter on quarter. So that's a very positive thing about the results.
No, microfinance, no. Let me just explain.
Yeah,
so, as sir mentioned, our book out to direct microfinance lenders is small, 10,000, 12,000. There we have seen their NPS go up a little. There's no question on that. But these are the best run MFIs, the best in the industry, the top 3, 4, you can call them. So therefore, we don't have any concern that they would start to show any concerns to us. And they have assured us by our conversation that they are on top of things.
Sir, this phenomenal growth of 84%, could you kind of, is this going to be the run rate, or could you throw some light on what led to this kind of a jump in profit? And also, could you also share something on stress loans? It's fallen, so was there some one-time recovery, or did you all write off the loans? Could you share something on that? I have one more question.
First thing is on, in terms of the percentage jump in 84% cannot be, possible. But I think what we wanted to maintain is in terms of the consistency and continuity, in terms of the ROA and ROE. I think that is more important indicators than the absolute profit numbers. And our guidance on the ROA of 1% and ROE of 20%, 15% and above continue to be valid. I think we will work on that count. As far as the year-on-year movement, I think we also had one-time expense in Q3 FY24. That is not there. So that is showing the spike. While we have improved on every parameter, the substantial jump in profit is also because I think there was one-time exceptional item in Q3 FY24. The second question you asked in regard to?
Your stress loans have come down, gross and net.
There's no substantial, there's no major recovery or no major write-off. It is our usual run rate in terms of strengthening our recoveries has helped us. These are all small value recoveries, and we maintain that run rate.
So, assuming RBI reduces rates tomorrow, what is the kind of headroom or flexibility you will have to lower your deposit rates, and to what extent you think it will contract or impact your NIMs?
No, as far as
I'm assuming 25 basis points, so basis that.
No, as far as the rate cut impact is concerned, on the deposits, of course, we will take a call as we go forward through the ALCO. But the impact on loans and all, if it is a small rate cut of 25 basis point, I don't think there will be any significant impact on our earnings. I think our book, as you know, is significantly MCLR and fixed rate loans. And we have a combination of 60-40 as far as MCLR fixed rate to a floating rate, repo and T-bill. So, and the T-bill rate also we were able to negotiate, even T-bill is going down, we were able to negotiate or renegotiate the margin over that. So we don't see major impact of the rate cut in terms of the deposits or advances in the immediate future, because the deposits also will take some time to get repriced. So, and as far as the deposit repricing is concerned, we'll take a call as we go forward. EBLR is
28.84. 28.84. Yeah.
29. The EBLR is SME loans are also.
SME and housing.
loans are also.
We have the next question from Hamsini of Money Control.
Hi. Before I ask my question, I just want a clarification on EBLR. SME products will have an overlap between fixed rates and EBLR also, depending on the risk and category?
No. SME is mandatory EBLR.
Okay. I have two questions, sir. I'll go with my first one. Your cost of deposits is now at around 5.05, and you're talking about further strengthening your deposit base as well. Do you foresee a situation where, and last year around July or so, you came up with special deposit schemes which conclude in March. Do you foresee a situation where, like most of your competition is, possibly have to give out a little more on deposits in order to fortify your position there, in order to ensure that you remain the market leader in that front as well? And what would, if you, especially in a market where we're expecting that the rates will go down, would we be comfortable with such a strategy?
No, we always held, earlier also I mentioned, for us deposit mobilization is a franchise activity, right? We always try to compensate our customers adequately. And we have a very loyal customer base, and obviously they need to be taken care of. But if any policy rate cuts are there, to affect the policy transmission, probably we may have to look at repricing the deposits. And as far as deposit mobilization is concerned, I earlier also mentioned we would like to compete on our service quality and the reach, and giving some additional benefits to the customers in terms of privileges, what is permitted regulatorily, than competing on the price.
Okay.
Yeah.
My other question...
Okay, all right. That's the SBI management clarifying on various parameters out there. For the time being, the stock is down close to around 1.5% or thereabouts. It bounced off the 750 mark, moved into the green, but now I think a bit of a trading move is what is taking place. I'll tell you what, we'll slip into a short break, come back, we'll continue our focus on the markets. We'll focus on a couple of stocks that are moving around. And Tushar Pradhan as well is waiting for us. He'll give us his opinion about markets and stocks and sectors that he lacks. Welcome back. Well, the markets actually have seen a bit of a recovery from the lows of the day. HUL is cutting its losses, so good on that one. And the big boy, HDFC Bank, that's the one, that's the reason actually why the Nifty has recovered close to around a quick fire 30 points on the low point of the day. HDFC Bank moves into the green, takes the Nifty Bank with it as well. But the biggest loser on the Nifty today is Trent. Valuations not in favor. The numbers a little bit lower than what the street was working with. And when you trade at these valuations, the room for error is very, very limited. But Mangalam joins us to break it down for us. Mangalam, take it away.
Well, if you look at Trent's this quarter's numbers, the street was expecting a moderate set because the company had reported some moderation in the second quarter itself, and the stock had actually, hit a high then, and from there after it's corrected about 32 odd %. So the street actually curtailed its expectations down, and on that the company has gone ahead and not beat those expectations. They've just met those expectations. The stock at peak was trading at around 120 times, now trading at around 80 times. But the street is looking at EPS growth. This time around, if you look at it year on year, the net profit growth has come in at 34%. At peak over the last few quarters, the company would report EPS compounding over 50%, closer to 60, 70 odd percent. And the stock was trading at around 120 times. The PEG ratio, or the price earnings to growth, was close to around 1.5 to 2. Now with the multiple coming down to 80 times, the EPS itself has come down. The EPS growth itself has come down to around 34%. So you're still trading at around 2.5 times price to earnings divided by growth, or PEG ratio as it call it, and which is why the stock, despite having corrected, is seeing further correction. What's also something that the street does not like this time around is the fact that their fashion concepts have reported just a high single-digit like-for-like growth. So large part of their growth has actually come in from store expansion or portfolio expansion itself. And to that, the company has actually announced a plan of optimization of those stores. So basically what this means is that if there are small stores across the street or in two areas, they will just consolidate it and make it one large store itself. That's not as much a worry, but the only, a silver lining in these numbers is the fact that Star, that business is doing well. It's reported 25% growth. And at the same time, the double-digit like-for-like growth in Star is one of the portfolio bets that the company is making in terms of growth. Again, from an optical standpoint, 35% revenue growth, 34% EPS growth is much better than everyone else on the street. But these were moderate expectations. The stock had already seen a big run-up. And from a price earnings growth perspective, it had been priced to perfection, which is why we're seeing profit taking on that stock, or rather further decline on that stock.
Yeah, absolutely. It saw a big run-up, and it's seeing an equally dramatic fall as well. Maglam, thanks very much for that. Trent is now off about 36-37% from its peak, and the peak was 8,000 plus. Now, this is sort of a bit of a derating perhaps that's playing out as market resets its expectations. Let's discuss that and more with our next guest. We have Tushar Pradhan, Director at Hexagon Partners with us. Tushar, thank you so much for joining in. So, tell us exactly, and you've seen this play out in multiple stocks across sectors. This is not just a trend story, right? This is about the market bidding up something where it finds growth. And in India, fund managers typically love growth. And then when that growth has to be, those expectations have to be reset, which is what we're seeing in trend, sometimes it can be quite painful. How would you navigate a situation like this where perhaps the underlying business is still okay, but it's about expectations and delivery?
I think you hit the nail on the head exactly in terms of what the expectation of valuations are indicating. So if you're trading at 70 times, 80 times, essentially the expectation of the market at that value is that you're growing at 50% earnings growth at least. And as you know, businesses are not really that predictable. So even if you have a quarter of not so much of an exciting growth as is estimated in the valuation, you will suddenly find that incorporating even a smaller percentage of a lower rate of growth is going to collapse that stock, because that is what gets automatically incorporated in the future valuation. So I think the real alarm bell around valuations is that it is going to become extremely volatile if you hold on to stocks which are, upwards of 70 times, etc. of earnings, especially of businesses which cannot really grow at that rate. So when we are talking about, as you just mentioned, retail, I don't think the rate of growth, given the constraints around how you can actually expand that business, is just going to be blue sky. But as opposed to, say, something like a service offering, which doesn't have a constraint on capital constraint or a capacity constraint, then the growth can be really electric. It can be really rocket-like. But that's really where the excitement comes in, that it's not one size fit all to say 70 times is expensive, so avoid. 70 times based on what expectation, what delivery, and the ability to deliver a very strong rate of growth for a significant period of time is really what distinguishes valuation. It's not the number.
No, absolutely. And that's beautifully explained, Tushar. Let me try and apply this to another scenario. Like I said, the problem is the same. The sectors or the companies or the stocks could be different. EMS. And we saw this scare play out when Dixon's numbers came out, right? There was nothing wrong with the numbers. We all know the margin profile. We know the business. We know where all they're expanding. But it was the same situation. Here's a company that's, that's trading at a stock that's trading at almost 100 times. So you said in Trend's case, or companies which are in the retailing space, maybe continuing at 50% growth is not possible. What about EMS?
Here also, I think there is a significant amount of money that you're required to expand, right? So, for example, if you are into the AMS space, you will require facilities. Orders is one thing, but your ability to deliver an expanded base of products, it's not going to come overnight. And if you have invested in it, it is going to take a long time before it comes online. Essentially, the market is a little manic, which means that it starts to incorporate what the potential for a company is, maybe 2 years into the future, already in the price. And given, I would say, buoyant capital markets, it is likely that those kind of multiples may sustain. So it is not about being scientific about it. It is also being very conversant with what the sentiment is. So just let me give you a simple example. So for example, if you have significant foreign inflow of capital coming into our markets, company trading at 100 times, delivering on earnings growth, I don't think the multiple will get damaged too much. But just change the scenario. The overall underlying fundamentals remain the same, the delivery continues, but the sentiment changes, you will suddenly find a 20-30% drop in any 1 month or so. I think this is really the vulnerability that we're talking about. We are assuming that the fundamentals of all of these companies remain very, very solid going forward. But yet, they will have valuation risk.
Absolutely. Guys, that's a lot of food for thought, isn't it? I mean, the Indian market is so peculiar. You have a company, a result, 30% top-line growth, 35% PAT growth, margins at 18-19%. You'd say, what's the problem? Stock selling off 8-9% as if, skies fallen down. But that's the Indian market, I guess, for us.
Well, that's also the market where you had an 8% fall at the beginning of the week just because one fashion app got launched in an online format. So it's been two body blows for Trent this week as the stock has corrected close to about 15%. But BEML, that too reported numbers. Again, a case of high growth expectations, high valuation, a fantastic stock run up. But stock is unwinding today. Sharp sell-off now, 3% gone. This month, 15% lower. Revenues for the company degrew by 16% on a year-on-year basis on account of likely execution issues in metro and mining. Profits are down 49%. Gross margins have slipped by 220 basis points. Tushar, afternoon, where do you stand on the entire CapEx theme? So break it up for us in terms of power, industrial, defense. Do you have a preference or is it an avoid because of the volatility in earnings?
No, in fact, I would have a reverse view on this, that one needs to be invested in the CapEx cycle going forward. We have not seen one for a long, long time. And the current one, which will be coming, one has to be patient. One has to be very circumspect in terms of the entry points, because I think everybody understands that there has been a lull in terms of the government CapEx, as we saw in being an election year, etc. But that's going to pick up. If you see the kind of commitment in the budget, all of that is following through. There has been a lull as a result of it. There is going to be a lot of slack, which is in the current spending, which is actually going to come through into the numbers. And essentially, it will start falling in place. Currently, I think we are in a very, I would say, in-between situation, a transitionary phase, where the expectation of growth is so urgent into every quarter that there needs to be, a balanced look at what's going to happen. But if you were to ask me for the next 1 or 2 years where I would like to put my money in, clearly I think CapEx plays. And I think, as you mentioned, there is an entire spectrum there. And essentially a CapEx cycle works over the period of time, and different kind of companies involved in the CapEx cycle starts to do well over a period of time. So process industries, things which start from day one, are the ones which start to benefit initially. So we are talking about companies which make process machinery, even components going into it, even metal. Once the factories are up, then you have other kind of manufacturing which starts to build up as a vending, or let's say a vendor chain, a supply chain into the manufacturing process going forward. So there's another slew of companies that start to do well. And once the capital cycle is complete, then you have the actual OEMs, or I would say the companies who actually put the capacity up, start to make the upside. So you have a very interesting period coming ahead of us in the next 1, 2, or 3 years, where you'll see this entire CapEx play work out. So I would be very, very optimistic about the whole cycle here.
Okay, all right, Tushar, thanks a lot for joining in and filling us in with your take on the markets and how you see things getting positioned as we go ahead as well. By the way, The markets were still, the Nifty is still down close to around 100 points or thereabouts, but quite a few stocks have moved around. The notable one now is HDFC Life. That's moved to the high point of the day. So keep an eye out on that one. It's both the HDFC boys actually, HDFC Bank and HDFC Life, both of them moving to the day's high. Well, it's time for the Growth Code, an initiative by Grow and CNBC-TV18 that's designed to provide you with valuable trading strategies. This week, I sat down with pro trader Saurav Sisodia, the co-founder Quantify Capital, to understand how social media is fueling speculative trading. Let's hear out what he had to tell me. Sort of another important point is how has social media contributed to this speculative trading, especially among the retail investors?
So I think social media has a very big influence. In fact, I was reading an article that due to social media, speculative trading has increased a lot in last 5 to 10 years. And so if you see what happened with GameStop. So GameStop was a stock in the US. It was a company into gaming. There was an article on Reddit that, okay, so retailers bet against the hedge funds, and due to this speculative trading, the stock risen almost 400-500% in a short span of time, and the hedge funds actually lost money due to this. So this is the power of social media. But what traders have to do is not to believe anything that is there on the social media, do their own due diligence, because with social media you get so many insights, some influencers saying this, other influencers saying this. So I think as a trader, what you have to do is just try to gain as much informational content you can on social media, but not try to do any investment or trading advice based on social media.
Okay, all right. Saurav, how can traders distinguish between genuine insights and say hype-driven recommendations on social media?
Okay, so what they have to do is, if any influencer is talking about a stock directly, because SEBI guideline says that if you're not registered, you can't talk about stock. So if an influencer is trying to pitch you a stock that, okay, this stock is looking good, telling you to buy, I think that is something you should stay away. And one thing to do is at least see the volumes, like what are the daily average volumes of that stock. If the stock has like at least a market cap of less than 1,000 crores, then definitely you have to stay out, because these are generally pump and dump. And what a trader can do is basically follow people who are giving genuine insights, basically teaching you how to make money, how to improve your investment process, rather than giving you tips.
Welcome back. Markets actually have seen a good recovery. They have cut their losses by close to around 50 points. The Nifty actually is now above the 23,600 odd mark. So it took support at around 23,550, which is the support level we had pointed out earlier today, going by the options data. And expiry seems to be above that 20,600. Mitesh Thakkar is back with us. Mitesh, what are you doing? Did you buy the dip today? And what about individual stocks?
Megan, as I said, we already have a long position on the Nifty, taken around these levels, about 20 points higher from here, but then that's okay. Looking at the fact that, this still looks like a market which is positively biased, given the hourly to hourly charts are all positive. So I have two BTST calls. HDFC Bank, I think, is clearly, one which is leading the bank Nifty, providing support over there. That's a BTST with a stop at about 1737 for targets of 1760, and Lupin is the other one. Lupin is a BTST with a stop just below levels of 2172 and a target of 2205.
Okay, all right. Thanks a lot for that, Mitesh. By the way, two stocks before we go into that break. Castrol India. Now it's up close to around 10%. Remember, these stocks got an absolute hammering when that we saw that sharp fall. The stock went down, I think, to around 180, 170 rupees. And now it's seen a good bounce. They have the sweetener in terms of the dividend as well. And the other one is Reddington. It seems to have come out of its slumber. Good numbers, the street likes it. Commentary as well, fairly positive. That stock as well is up at around 230 rupees. Slip into that break, come back. We'll continue to focus on a lot of stocks. Don't go anywhere. Welcome back. Markets actually have seen a good recovery. They have cut their losses by close to around 50 points. The Nifty actually is now above the 23,600 odd mark. So it took support at around 23,550, which is the support level we had pointed out earlier today, going by the options data. and expiry seems to be above that 23,600. Mitesh Thakkar is back with us. Mitesh, what are you doing? Did you buy the dip today, and what about individual stocks?
Megan, as I said, we already have a long position on the Nifty, taken around these levels, about 20 points higher from here, but then that's okay. Looking at the fact that, this still looks like a market which is positively biased, given the hourly to hourly charts are all positive. So I have two BTST calls. HDFC Bank, I think, is clearly, one which is leading the bank Nifty, providing support over there. That's a BTST with a stop at about 1737 for targets of 1760, and Lupin is the other one. Lupin is a BTST with a stop just below levels of 2172 and a target of 2205.
Okay, all right. Thanks a lot for that, Mitesh. By the way, two stocks before we go into that break. Castrol India. Now it's up close to around 10%. Remember, these stocks got an absolute hammering when that we saw that sharp fall. The stock went down, I think, to around 180, 170 rupees. And now it's seen a good bounce. They have the sweetener in terms of the dividend as well. And the other one is Redington. It seems to have come out of its slumber. Good numbers. The street likes it. Commentary as well, fairly positive. That stock as well is up at around 230 rupees. Slip into that break, come back. We'll continue to focus on a lot of stocks. Don't go anywhere.
Welcome back. Another big mover is Bajaj Housing Finance. The stock has moved up close to about 4%. Biocon is adding some heft. And Bharti Airtel, by the way, has slipped virtually to the day's low, reports numbers later in the evening. Stock is down close to about 2.5%. It's expected to be a good quarter because the July tariff hikes will still benefit them in the current quarter, but the stock is a bit subdued. Amrish Balika is now with us. Amrish, your pick for the day?
Hi, Rima. My pick for the day is IndusInd Bank. It's the fifth largest private sector bank, has about 7,135 points of connect, one of the largest distribution networks, and they have about 6.6 lakhs merchants. Well-diversified loan book across consumer as well as corporate products with a 54 to 46 mix. Leadership position across many products, and in vehicle finance, they are among the top 3. In microfinance, among the top 2 with about 13 million customers. They have about 91,000 Bharat Money stores and have a reach to about 1.61 lakh villages. The microfinance book had some asset quality issues since the last 2 quarters, and we have seen a decent correction in the stock because of this. But then microfinance industry could actually see the pain reducing, I think, by Q1 FY26. This is clearly as per the management commentary across the sector, not just IndusInd. Q3 profitability numbers also were weak, but they were in line with market expectations. But then you look at the business, I mean, that continues to grow. Retail deposits are up about 14%. Vehicle finance disbursements are up about 25%. Corporate loan book grew about 16%. So because of this, we have seen some amount of bounce back. And if you look at the financial parameters, CASA ratio is 35%, NIMs at about 3.93, a tad bit below, the Q2 numbers. PCR is 70%. So downside from here seems limited. And I would revise my long-term target to about 1,375, which is one-time adjusted book value for FY27.
Okay, all right. Very quickly, Amrish, could you tell us on the cement pack you like anything? JK Lakshmi Cement comes out with a set of numbers later today, and that one's at the high point of the day. What's your take?
No, I think from here on, we should actually see the cement sector as such doing decently well, because I see that the execution should actually take off. Although in the budget, the top line numbers were more or less kept same like last year. But then I see the execution picking up. And along with that, the reality space also is doing well. So we should see margins improving for the cement sector overall. And here my pick would be the largest in the lot is Ultratech.
Okay, all right. Well, Amrish, request you to stay with us. We'll just wind down the markets and come back to you on markets forward. Well, it was not a bad day of trade. The Nifty goes home with a cut of around 70 points, but the Nifty Bank was up close to around 80 points, offsetting any kind of weakness that we saw on the non-banking names. What did well? The reason we managed to end in the green was because of HDFC Bank. That led the fight back in today's trading session. In terms of result reactions, SBI was a bit of a subdued set of numbers. However, positioning was such that the stock was down only around 1.5%. Trent, that's been the big outperformer, results not up to market expectations. So that's why that went home with a cut of around 8%. On the flip side, Cipla was a stock that did very, very well in today's trading session. But you had a lot of gainers in trade. Reddington, the numbers were quite good. The stock goes home with a solid gain. You had Welspun Corp as well. The stock initially did see some profit taking, but the commentary was very, very good. So that's why that stock was flying away in today's trading session. Reliance Power, Reliance Infra, both of them did pretty well in trade. And Care as well was up close to around 7%. So a good trading session, one would say. Yes, the headline index, we were down close to around 60, 70 points or thereabouts. But otherwise, the breadth of the market, even Stevens, and you had plenty of opportunities there in the broader markets.
Well, just want to point out Swiggy. Swiggy ends with a cut of about 6.5% as competition expansion weighs on the Q-commerce margins. So the stock took a bit of a tumble. Other losers included Kalyan Jewelers, 4.5%, REC, Vishal Megamart. You had NHPC, Suzlon Energy. These were some of the big volume-led losers today. But markets ending in the red, big caps underperform. Some jitters, anxiety perhaps ahead of the RBI policy tomorrow. We're going to take your leave and closing bell, but don't go anywhere. On the other side is Markets Forward.